The markets are a machine for multiplying money. Welcome back to Jake's Wealth. So when you think in terms of percentages, you might translate those into numerical forms, but they are far from numbers. When you think 3% and the number 3, basically think on the number 3 as being multiplied by 10. Man, percentages are like numbers on steroids. Yeah, they both have 1, 2, 3, 1, 2, 3, but when you're talking about these percentages, it's like you just want to be on the right side, and the market will give you that, but it's up to you to correctly put your money in the correct places. Like, for instance, do you want your money on Beyond Beef, or do you want it on the S&P 500? Like Tesla's going to be more volatile buying Tesla than it would be buying an ETF like the S&P 500 ETF or the VIX or the View, the Vanguard. Like, these trusts have 500 companies. So I see the equation to properly trade as there's value, and then there's the math. And the math is simple. Like, if you've completed high school, you can understand the math, as in you want to be on the right side of things. Like, there's steps to trading, as in, like, you want to be on the right side first of all, because I've been playing the game. I played it all throughout school. I've lost so much real dollars, and now I'm beginning not to lose so much real dollars and make a little bit. Are you going to make a lot? It's up to you. Like, are you going to survive the game for a decade, 2 decades, 3 decades, 4 decades? It's never too late to start, whether you're 18 years old or 80 years old. It depends on the amount you're starting with. If you start with $100 or $100,000 or $1 million, $100, you see 4%, you're going to have $4. That doesn't equate to a lot in the real world, what things cost. It's really, you want to look at this like it protects you against inflation. If you could just be up, let's say 2% on the total stock market index, the Vanguard, and you have $1 million, that's $20,000. Now, you don't want to lose your initial investment, so that could be a good place to where you move your stop loss. I mean, I don't want to break it down too simple, but it's like, you look at the graph, you look at the numbers, you look at the trend and the momentum, and it's going to be volatile. Like, on average, the Tesla may swing back and forth 10%, while the Vanguard may swing back and forth less than 3%. So if you wait for 2 weeks after investing in the Vanguard and you want to trade it and you're profitable, let's say you start with $100,000 because you're using margin, you got the initial $25,000, they give you 4x margin, most trading platforms. And you put all your chips in one basket, which is the total stock market index, which covers, I don't know, 1,000 companies, more or even more. I don't know. I just know when you invest in one company, it's not, you don't have the momentum, you don't have the trend like you would if you had 1,000. It, automatically diversify. You could buy 1,000 companies, or you can buy one ETF. You're more likely, like, it's just a game of averages, like what works better, and there's so much patience involved. After one day, you're not going to see a great return on $100,000 investment. You might see 0.2, which, that equates to a couple $100. But if you continue to wait, and like the next day it's up 0.5%, then it's down 0.3%, but you don't sell it, you continue to hold, and then day 4 you're up like 0.5% on the total stock market index. Because over time, if you just hold on to these big ETFs like the S&P, the Dow, which is included in the Vanguard, and the NASDAQ, which is included in the Vanguard, VOO, ticker symbol to trade, you're going to have the opportunity to set your loss at break even, so you can't lose money with upside potential. But you don't want to set your stop at break even when you're 0.5% above, because the volatility, like I said, was 3%. So you're going to get stomped out. You're going to lose your profit, but you're not going to lose your initial investment. If you're patient, after a week, 2 weeks, 3 weeks, you could see a guaranteed return of 3%. And that's when you want to consider moving your stop loss to break even. And then you just look for the past 3 weeks. Where's your support and resistance level? It's really, really simple when you've done it wrong so many times, because then you get into the position of, okay, worst case scenario, I get my initial investment back. Okay, worst case scenario, I make $100. Okay, worst case scenario, I make $1,000. Because you've done the math, you've set your risk. Maybe you've risked, if it's trading at 200 and 2 years ago it was at 100, so now define how much you want to lose if, let's say, the market drops by 50%, which is not so likely, but you're going to have value. You're going to be able to allocate assets into whatever you're looking at. For example, I like the diversified ETFs. Those don't give a greater return, but you're more likely to get a return. And over time, if you're patient and you play the more likely to, in quotation marks, because it's more likely that the total market is going to move up, then it's more likely that Beyond Beef is going to move up in the next 2 years, especially if the trend is down. Like, is the trend down from 2 years ago? Is the trend down from a month? Is the trend down from a week? So then you can start to see your support and resistance levels once you're in profit on the Vanguard, and you say, all right, 4 days ago, like the market went sideways. That's good. There's a lot of orders there. When the price comes back down, it's likely to hit and bounce in your direction because you're long the Vanguard trading it and you have a 3% profit. Now you set your stop loss at a 1% guaranteed, because that's where there's support below where the price is currently at is trading, and that was above where you entered the position. It's extremely complicated if you don't draw a mental picture and say, okay, there's value and then there's math. We know the value side is good for an ETF when you're diversified, because you could spend a lot of time in real life trying to, you have $100,000, you want 100 good companies that are trending, more likely to be worth more valuable, and you invest $1,000 into 100 companies rather than just buying one company, or 4 ETFs. I think anybody could easily manage 4 ETFs. You're losing. It's getting closer to your stop loss, but that was 2 years ago. Be patient and hold, because next month, I guarantee you're going to see a good return, because that's just how the market works. I mean, you give the market what you can, and the market gives you back what the market's going to give you back. There's no influencing, as in saying, wow, if I'm more risky, I'm going to get a bigger return. That is true, but at the same time, you're going to have more risk, and it's going to be, if you have a lot of risk, it's just going to feel like a casino at one point. At some point where it's like a casino, where it's like, man, I don't even know if I'm giving the market like what it's giving me back, because my risk is so high. I've lost 2 in a row. I've lost 4 in a row. Is this time to throw in the towel and say, I can't? Maybe this isn't meant for me? Or is it time to say, you know what? I have a long-term outlook. It's never too late. Let's learn what I did. Let's go back and review what I did incorrectly, and next time around I'm going to do better, because I know not to do that incorrectly. Once you know 100 things not to do, you're going to arrive at the answer. That's just science. you're gonna have an answer. Like, this is the right thing to do. This is proper. I believe in what I am purchasing. I see the returns, but I'm not going to spend the returns. I'm going to let it ride. I'm going to let the returns ride by setting my stop loss at break even, finding the support and resistance levels, maybe guaranteeing a little bit of profit, and continuing to be patient so you can allow the market to give you what the market's going to give you. If you're not in the position for 3 weeks and you're only in the position for an hour, you might see a little profit, but next time you might see a loss. What are you doing when you have a loss and it's bigger than the profit you just took? You wish you could go back and hold for just longer amount of time. Time is the real winner. Time is what wins. Because when you decide to start trading, you're going to be like, oh, this is so easy. Like, I could just make money by making profits. But at the same time, if you're making a lot of profits, somewhere within the math or the value, you have a great substantial risk, because there's nothing that I've found or know how you can have just no risk and a lot of reward. Doesn't occur that way. So it's always like, take the low risk, put all your chips in 5 baskets or in 1 basket, up to you, and from there you can build up a position. And then once you're in the position, you can see the price at 50 and say, okay, I'm in the position at 45 a share, it's at 50 a share. If it comes back down to 47.50 a share, I'm gonna purchase 25% more, because that's the support level. You can do that, and that requires math. It's like, how many shares do you need to purchase at 47.5 so your initial position moves from 45 to 46.50? Do the math, because that's a great support level. If it goes below, I'm stomped out. I get my initial investment back, and you lose time, but you don't lose resources. And if you can continue to keep your resources, you're going to arrive at the answer eventually, once you've tried and tried and tried and tried again. Check out my other videos. Going to release some shorts. My name's Jake's Wealth. If you've made it this far, congratulations. I'll see you at the top. Thank you.